You can't trust a regulator that's also the world's largest debtor. Just because the government backs their industry, the bond market, doesn't mean that bonds are safe. And I would argue the U.S. government won't default. They'll just inflate or suppress yields. But either way, you hold bonds, you lose.
If you look at a 1% increase in gold in global portfolios, that equates to a demand at current prices of 25,000 tons, and it is not there. It's quite simple. If you leave this one, you're going to miss the boat.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for October 27th through November 3rd, 2025, while supplies last. First this week, 1-ounce gold Valcambi combi bars that can be broken into 10 1/10-ounce bars are just $215 over spot. Next, 90% constitutional silver is just 30 cents over spot per ounce. Finally, assorted silver rounds are just $2.99 over spot per ounce. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Welcome to Liberty and Finance. I'm delighted to have a special event to be the host of today. We have an asset management panel comprised of Alasdair MacLeod, former bank director and former head of research at goldmoney.com, now the head of his own Substack at MacLeod Finance. Alasdair, thank you for joining us.
My pleasure, DK.
Also, we have Andy Schectman, the CEO of Miles Franklin Precious Metals, who is not only an expert in the precious metals industry, but also a widely sought after speaker on the global perspective of coalitions of countries that are aligning to pivot away from the U.S. dollar and the U.S. Treasury and traditional forms of asset management. Well, I should say modern forms of asset management into more traditional forms of asset protection. Andy, thank you for joining us.
Never thought I'd hear my name in that context, but it's pretty cool and it's good to be here. Thank you, my man.
Well, it's interesting. It's kind of like Back to the Future or Forward to the Past or something, because it seems that the time-proven methods for protecting and preserving purchasing power and assets and reducing risk have been largely pushed aside in the modern era. The last 4 decades of artificially low interest rates and benign economic conditions have, as Rick Rule, who unfortunately hasn't able to join us this morning as we thought, reminds us that the landscape has changed. The forward-looking decades do not resemble the most recent ones we're coming out of. And so we're trying to do this on behalf of asset managers and money managers who are coming out of perhaps a 40-year period of following certain methods and strategies that have been very effective in this past environment for managing risk and accommodating the modest rate of monetary inflation and debasement of the currency that has existed in a environment that some people say has resulted in the bubble of everything, both stocks, bonds, and real estate, all being simultaneously highest valued in history based on even internal metrics. So we're here to try to talk about how the landscape has changed and considerations that money managers and those protecting assets on the parts of ordinary moms and pops, as well as institutions such as churches, schools, foundations, etc., may need to change or consider changes to their game plan in order to protect and preserve their asset values in the forward-looking environment. So, Alasdair, you often speak in front of significant audiences on this topic. Can you talk to us briefly about how you see the economic and financial and monetary landscape having dramatically changed so that what makes the road ahead look different from the road that we've just traveled?
Yeah, sure. I'll try and put it in a context which makes sense for investment managers. We are in a credit bubble. There is no doubt that bank credit has been expanded in favor of financial assets. And more than anything else, this is really what drives equity markets in particular. And we've seen this. We've seen this really over the last 2 years with the S&P rising from 4,000 or less or whatever. Currently, we're looking at 6,900, thereabouts. I never follow it that closely, but I mean, we're talking about a substantial rise. And the background to this has been a gentle drift in bond yields. I mean, they peaked, if you look at the 10-year, it peaked at around just a bit under 5%, I think, a couple of years ago. It's gone back and up and down. And currently, it's around about 4%. So that has been a fairly benign background against which there has been a substantial increase in the amount of credit aimed at assets. And if you look at the level of margin finance, which is a statistic that FINRA runs, margin finance is running at an all-time high. I mean, we're looking at $1.12 trillion. Bearing in mind that 10 years ago, we were looking at about $250, $300 billion. We're now, we're now well over $1 trillion. Now, the point is that finances positions probably about 3 times that. So there is a substantial amount of froth in these markets. So we have an equity bubble. So far, this is rather like the Roaring '20s, 1926 to 29, when everything was tickety-boo. Everybody in Wall Street was extremely happy. People in Main Street weren't doing terribly well. They were holding body and soul together, but not an awful lot more. But, the real happiness was really in major city conurbations, where all the wealth was being created in markets, and it was sort of spreading out into the restaurants, into second homes, into fancy holidays and all the rest of it. And that's where we are today. The problem with these bubbles is that they do come to an end. And when they come to an end, it can be really quite sudden and quite violent. And I think for an investment manager, that's the first thing he's really got to understand. He may be a very clever fund manager and made an awful lot of money for his clients by, sort of playing the momentum stocks and Bitcoin or whatever. But just bear in mind, the whole thing is driven by credit expansion, aimed at puffing up assets. And that basically is what's been happening. That comes to an end. And if you're left holding the baby when it ends, you are going to lose an awful lot of money. So I think that's the first thing that you've got to plan for. When it pops, then there is going to be a huge second problem, because when it pops, you're going to get a market that goes down considerably. I'm talking about equities here. You will see an increased amount of risk in bond markets, which basically means their yields will rise at the same time. Now, this is an awful combination, but this is what happens. This is what happens when a bubble pops. And consequently, you find that, all that margin debt, it gets foreclosed, and you get a situation where people who have portfolios which they're using to secure other finance, they get sold out because it no longer covers the bank's liabilities. You've got other problems that come from the increased risk being reflected in higher bond yields. You've got all the zombie companies in the economy who took out all that debt, particularly when interest rates were at the zero bound, and in other countries at negative interest rates. They're in the business now of having to refinance that. I mean, we're looking 5 years on. So this is not good. And as far as government is concerned, they've got huge debts, which are going to prove to be even more difficult to finance in the event of rising bond yields. So how do they handle all this? They're going to have suddenly all these obligations coming through, because apart from anything else, their welfare obligations are going to go up. And at the same time, their tax income is going to go down. So they're going to have larger budget deficits. So, this is going to be very, very difficult. So that's the second, if you like, element, which I think you've really got to start thinking through. In terms of investment strategy, I would look to sort of start easing my way out of the momentum stocks. They may go further, You're never going to hit the exact top. But I would look to lessen my exposure to those. And the other thing I would then do, and maybe not immediately, because I think as the bubble pops, you're going to get a substantial amount of selling across the board. And anything where people have got profits, they're going to be just realizing them and running the losses. I mean, that's the way it works. So there is going to come a time, I think, when you're going to sort of start thinking, right, we've got to invest in mining stocks. And I'm not just talking about gold and silver, but base metals in particular, agricultural products perhaps, because I think these prices are going to rise. They're going to rise very, very substantially. That's going to be the new place to go. And good technical analysts are already seeing this beginning to develop in the wider commodity sphere. So I think that's your game plan. The timing obviously is up to the individual investment manager, and I wish him jolly good luck. So to summarize, I think the first thing is you've got ahead of us, we've got a credit bubble popping. But realize that when it happens, this sort of neo-Keynesian idea that the Fed can control interest rates and bring down interest rates and bring down bond yields. No, that's rubbish. That's not going to happen, because what will happen is that bond yields will start reflecting the risk in credit. Not risk, but just add the three elements of this risk. If you go and buy a bond, you're losing possession of the money, if you like. It's going into the bond, so you can't use it for something else. So there's an element of interest payment to cover that. You've also got individual borrower risk. So that is another thing that you take into account. And increasingly now, there is another factor. And that is, when I get my money back, let's say dollars, let's say in a year's time, what's it going to buy? What's it going to be worth? What's the purchasing power of that money which I've committed to a bond or whatever? What's that going to be worth? So you can see that these three elements are likely to rise quite considerably as credit risk begins to dominate our thinking. And under those circumstances, I think the forward thinking that an investment manager does has got to sort of, if you like, just encompass those very, very facts. So I think that's what I would say in the current situation.
You've underscored there quite a few salient points about the current market conditions and strategies around it. Andy, did you want to add anything about some revelations of official endorsement, even by major players recently, about bond portfolio, the traditional portfolios needing to be broadened to include intrinsically valuable assets, so strategically tangible asset as part of a mix?
Yeah, I think it's important to highlight those in the respect that a lot of what Alasdair is talking about it deals with just this: monetary inflation, asset valuation, the inflation-adjusted value of bonds and equities. When you have a Federal Reserve that has missed their target inflation rate for 55 straight months or thereabouts, of 2%. In fact, missed it by 50%. They call that tepid. I don't know how missing your rate by 50% is tepid. It seems kind of way off base to me. But there's a lie, of course, about what inflation really is. It should be called the CP lie and the BS, not the BLS. And we know that. We've talked at length. John Williams says inflation's 11%. Shadowstats.com, not 3%. So nominal returns, to Alasdair's point, are an illusion when inflation certainly is higher than we think. But, even at 3%, and they're trying to push rates down below that, but even say you get a 5% return, right now you're losing in real terms by John Williams' measurement a negative 6% real return. And in that environment where you, to Alasdair's point, have record participation by the public in the equity market, record amount not only of margin debt over $1 trillion, but also record speculation and leverage with options. Bonds are very vulnerable, and equity valuations are very distorted. So earnings may rise, but real purchasing power is falling. But the real trouble, to Alasdair's points, in the bond market, and that's why when you see the chief investment officer of Morgan Stanley come out and say, well, the 60-40 rule that we've used, 60 stock, 40 bonds for 50 years. Now remember, and since 1982, when the interest rates have fallen straight down at a 45-degree angle, if you're 60 stock, 40 bonds, you'll retire wealthy, period. That's not really the case anymore. And so as the chief investment officer of a large commercial bank who has never acquiesced to anything more than a pittance of gold in your portfolio, he says, sell half your bonds and buy 20% gold, 60-20-20. You got Michael Hartnett, the chief analyst at Bank of America, says, no, shouldn't be that either. It should be 25, 25, 25, 25. Stock, bond, short-term treasuries, gold. You have Jeffrey Gundlach, the bond king. I think he's the head of bonds for BlackRock, says, 25% allocation to gold is not overweight. This is a guy that's made his living selling bonds, the antithesis of gold. And you have all of these institutional level advisors and chief investment officers saying, yeah, you need to own some gold right now. And in all three cases, it's at the expense of the bond portfolio. You didn't hear them say trim your 60% stock portfolio. So yeah, right now I think there is no question that the world is beginning to understand that not only is the Fed trapped, raising rates blows things up like the bond market and all of the institutions that hold their wealth in treasuries like the banks and the insurance companies and the real estate market. And we're already looking at a Fed, they're projected here to lower rates into an environment where they're missing their target by 50%. That's acquiescence. We're going to give up, in essence, our mandate without really acknowledging it to inflation target of 2%. And by the way, it's funny, as a side note, just for those people who haven't heard, I asked Judy Shelton, I said, Judy, why the hell did they ever come up with this stupid 2% rate anyway? Shouldn't it just be zero, flat prices? Wouldn't that make standard of living better? She says, it was Janet Yellen's husband who came up with it, actually, and he said, if you do that, you can't give your employees raises because it'll come from the bottom line if everything is stable. But if you have a 2% inflation target and give your employees a 1% raise, they feel like they're getting ahead even though they're falling behind. And that's really what's happening here. We're all falling behind in the face of a dollar that is losing value precipitously. Last thing I will say is that when we look at the value of the dollar in terms of purchasing power, which is important because that's really what it is. Alasdair says you might get your money back, but what's it going to be worth? We're misled by measuring it against the Dixie, the other crap currencies that are all losing value. And the dollar was down 11% against these crap currencies. It's rallied back to 7 or 8%. Okay, but let's measure it against gold. It's down 50%. Against silver, 60%. How about last year? Same thing. When you measure, if you go back to 1971, James Rickards would say gold should be $94,000 right now, measured against gold. When you measure the dollar against a basket of worthless currencies, it's masked. So everything that we are doing is stacked against us in measuring against a basket of worthless currencies. Measured against gold, and everything is falling in price. And I think the asset managers must understand that even the best laid plans, those that have worked for 50 years wonderfully in an environment of dollar supremacy, in trust of the institutions of this country and of the bond market that has been weaponized and sanctioned, those things aren't the same anymore when that environment changes. So yeah, to Alasdair's point, you must pivot if you are looking at a macro perspective here. And when you see all of this congregation in the equity market on leverage and on margin and using options at record levels as the institutional sized traders and have been selling all year, and Buffett sitting on $500 billion in cash, what could possibly go wrong? The best laid plans need to be reevaluated, and this is the time to do so.
If we could leverage a couple of things that you said, Andy, and then get Alasdair's take on that from the international perspective. You mentioned some very high profile in the Western financial arena, advisors coming out, banks and Bond King and so on, were saying you really must be considering gold as a significant portion of your portfolio into preserving asset value going forward. This is new to come from high places publicly in the West, but Alasdair and then Andy, again, if you could underscore how this has been going on full speed for the past 5 years, arguably, internationally, and the West is the last to be waking up to the fragility of relying on the Western markets and dollar. Alasdair, perhaps you can lead us, because you've talked to us multiple times before that, how it's always those inside the bubble that are the last to see the weakness.
Yeah, I mean, it is interesting that the first time, certainly during this fiat currency life, which is now 54 years and counting, we actually have major investment managers, or rather, I suppose, investment strategists turning around and saying you ought to actually allocate, 5, 10, 15, 20% of your portfolios to gold. The thing that's interesting is that these big banks, they've got massive amounts of funds under management. And, we're talking about the sort of net worth individual portfolios. The sort of thing I understand people like Goldman's have got about $1.25 trillion under management, Bank of America another trillion, trillion here, trillion there, and all the rest of it. And they got nothing. They've literally got no gold in there at all. They don't know how they're going to get it. I mean, really. And there's another problem, and that is that, how do you invest in gold? Well, your compliance officer won't give you hell if you buy an ETF. But an ETF is actually quite an expensive way to do it. What you should do is buy physical metal and store it properly. And it'll cost you, basis points, no more than that. But the problem there is that gold and silver are not regulated investments. So you've got a lot of explaining to do to your compliance officer. But that's the best thing to do. I'd sort of calculate, if you look at the actual level of exposure at the moment, portfolio exposure to gold around the world, and we're talking about an estimated 300 trillion of portfolios total around the world, their exposure is about 0.5%. If you're going to increase it by only 1%, at current prices, that's 25,000 tons. Where are they going to come from? It's just not there. So I think we're in a situation which we've already beginning to see a squeeze in the market, and this is something Andy is probably a lot closer to than me. But I mean, when I saw all that stuff going out of the Bank of England back in April, the trucks backing up and being told, come back at the end of the month, I started thinking, that's basically leased gold, which before then was just remaining in the vault. Okay, it was a book transfer. So the Bank of Finland would own, say, they would lease, say, 50 tons, and it would be leased to XYZ. It was a book transfer because it would remain in the vaults. Now it's disappearing. Now, if I was a central bank, and I don't think I'm stretching my imagination too far, I would think, hold on, I don't think I want to get involved in this leasing game anymore. I think I'm going to stop leasing because it's now getting more important that we actually have possession of our gold, or at least have it stored without any encumbrances, such as out on loan to someone else, leased to someone else or whatever. So I think that's drying up the whole of the mechanism, if you like, in London. So what I'm saying is that, it's all very well turning around and saying, put 20% of your portfolio in gold. It's not there. And worse than that, the liquidity actually is drying up. The liquidity that's keeping the paper market going, because this leased gold, it gets hypothecated, rehypothecated, rehypothecated. It just goes round and round and round, and it's like spinning plates. You used to have those chaps on the stage with spinning plates on the end of, and you'd go around and get dozens of these things spinning, and see them starting to fall, to get round and sort of get them going. That basically is the gold leasing game. And a lot of this gold has actually gone. It's disappeared. I mean, the leasing game has been going for so long. Analysts back in the last century were looking at it and saying, where's it gone? And they were assuming that after a lot of diligent research, I should add, that up to a third to a half of all central bank gold by 2002 was out on lease. And the way Frank Venerosa put it was, probably adorning the necks of women. I actually think China bought it, but who cares who bought it? It's not there. I mean, that's the key thing. So we actually do have this additional problem. I mean, the idea that you're going to have time to, sort of cogitate and wait to see developments and all the rest of it. I mean, you could end up missing the boat hugely on the gold game. And of course, the thing about silver is that it's always been the poor man's monetary metal, as it were. And, if they think they've missed the gold boat, they'll go and buy silver. So, and there's not a lot of liquidity there. I mean, I'm seeing that in China, stocks have dropped to well under 1,000 tons in the SHFE. This squeeze is evident again. And I see that this morning, there's a small backwardation between spot in London and COMEX. So that's returned after one day. I think it's 1 day of normalizing. So the situation, I think, when it comes to the availability of metal is not there to accommodate investment strategies turning around and saying, well, you should up your gold content. And I think what it means is that you should actually buy it sooner rather than later, sooner before all the other guys.
Yeah, those are three takeaways that I'm hearing from you. One is we have seen these official pronouncements from governments before saying, hey, this is a good idea. We need to go in this direction. Another example would be green energy. We need to be at 30% or pick some number of electric vehicles and wind source and all this stuff just by policy. And then suddenly the mining industry goes, wait, guys, we're 20 years behind on producing the copper and the aluminum and the rare earth minerals you're going to need to make all this happen. The grid isn't ready. Nothing's ready for that. So there's this big disconnect between pie in the sky policy statements that perhaps are directionally correct, but absolutely unrealistic in terms of the ability to scale into that as an industry. That was one of the questions. Which asset classes, in your view, have the greatest inflation protection characteristics, and are any of them realistically scalable for institutional balance sheets? You've cautioned us that, guys, this isn't as elastic, this supply, as you might wish to cover this sudden jump from 0.5% to 20 or 25% that Andy was at. So then Andy will remind us that this specter of illusory availability of gold that the exchanges have been able to maintain with smoke and mirrors, or plate spinning, as you call it, Alasdair, have been gotten wise to by a number of countries who've been desperately trying to repatriate their gold to make sure that they've got it in hand, a bird in the hand. Andy will remind us of that. And then how that then favors early adopters, because in a realistic, when the tangible assets have to be physically owned or not owned, and you can't just rely on paper promises or future promises or anything like that, then it suddenly gets very real, and late comers to that party find that the physical is all locked up and all gone. Andy, could you address those things about the realistic scalability of the pie in the sky percentage allocations that are being recommended now versus what's actually available? Secondly, the scramble for repatriation that's been going on as quietly as possible over the last several years so as not to spook the market, and what it means to be an early adopter rather than a late entrant if there's a finite, limited supply.
Well, first of all, to your first question, guys like Jeffrey Gundlach and Michael Hartnett and the CIO, Chief Investment Officer, Morgan Stanley, are not speaking to the plebes. They're speaking to institutional level traders. So they're telling the people at the top of the financial food chain, this is something you've never heard from us. So we're couching it by just calling it 60-20-20 or 25-25. Michael Hartnett's newsletter is so expensive that no one mainstream reads it unless you are a institutional sized trader or hedge fund, running a hedge fund or whatever. These people at the top level are being given the acknowledgement, the wink of the eye, if you will, by the same banks that have been suppressing the price. At the same time, we've talked at length about, and I started my first couple podcasts with you in 2020, we talked about the others that showed up on the Commitment of Traders report, which there was always just two groups of reportables, the largest positioning, Commitment of Traders report published by the COMEX were the hedge funds and the commercial banks. Then all of a sudden there's this group called the others. Who are they? They are sovereign wealth funds. They're central bankers wearing a different hat. They're friends. They're an offshoot, if you will, or family offices of tremendous wealth started standing for delivery, which I'm like saying to you, Dunagun, this never happens. What, less than 1% have stood for delivery my whole career. At this point, it's been 30 years I've been doing it. Something's not right. And now we see it. Of course, we've seen it with almost 40 central banks repatriating their gold from the Bank of England and the New York Federal Reserve. Early adoption into backwardation right now. We see problems of getting the metal. Sorry, there's a 8-week delivery delay, folks. We have a shortage of manpower and trucks in London, we were told. Or, not really a good example, but gets the point across. Venezuela says to Bank of England, can we please have our gold back? No, you can't. And when you see 40 countries pull their gold home from the Bank of England and New York Fed, they were there because for many years you had the Western rule of law and stable, liquid, efficient markets, the COMEX and the LBMA. They don't care. And you're seeing exchanges, the Shanghai Metals Exchange and their expansion in multi-jurisdictional expansion, one being built right now in Saudi Arabia, one just completed in Hong Kong, which allows you to take metal off of the exchange through Hong Kong and receive it directly by trading yuan into it. The people who are doing this are the central banks, and they are the most well-informed traders on the planet. That's number one. Now it's moving to the commercial banks who are telling their institutional-sized clients, early adoption is everything. And this is why most people fail at investing, because they move rather than trusting their intuition and listening to the rants of a guy like me. What the hell do I know? Or Alasdair, what do we all know? Well, we've been right. And we have been right. By hook or crook, we've been right. And, you know, we were laughed at. And you look at an environment where Wall Street refuses to acknowledge it, but now they are at the highest level. But they don't tell you, yeah, we've been wrong. We laughed at all of you guys who wanted to buy gold and silver, yet it's outpaced the 10-year Treasury 2-to-1, doubled it. It's beaten the S&P 500 with dividends reinvested for 25 years, which, by the way, no one ever does. No one ever does reinvest all their dividends. But we are living in an environment of negative real rates, and you could argue yield suppression, where they're trying to keep the yield down best they can, monetization of assets. And this has pushed investors for a long time into risk assets, which have inflated valuations, like all the Mag 7. And it's hiding the risk. And that risk hiding, well, the insiders know. Why do you think they're leaving? As the public's chasing that FOMO. This isn't free market pricing at all. And the assumptions of return are off. You can't make these assumptions in this environment. And I think, to Alasdair's point, the one thing about having gold and silver in your hand is it is an asset that has no counterparty liability. And if you do it before the masses figure it out, like the way the central banks started doing this 5 years ago, 6 years ago, 7 years ago, and then the others being the sovereign wealth funds, and the commercial banks, these are people at the highest level. So yeah, I would say it's everything. And to Alasdair's point of the ETFs being expensive, yeah, you're paying BlackRock and JP Morgan a 60 basis point management fee to, in essence, use your metal to drive the price down. There's an 81 million share short position in SLV right now. And what the hell is that? It's just, as Ed Steer says, it's grotesque. And it is. This drives the price down. It allows them to pull metal off elsewhere. But, you're paying them a 60 basis point management fee. You can store in one of our Brinks facilities for a fraction of that. Real stuff, which you can never take possession of SLV or GLD. It is expensive. But through all of this, and even this month where we've seen a big fallback of 10%, 58,639 contracts taken off. Multiply that times 100, you got 586,000 ounces of gold. No, 5,863,900 ounces of gold taken off the exchange, and multiply that times 4,000. So you're talking an awful lot of money worth of gold coming off just this month, but it's been that way every month since November. So what's the takeaway? Well, the takeaway is this. Starting in 2017 or 17, the central banks started buying and repatriating their gold. And then it proceeded to be the family offices, the hedge funds, the sovereign wealth funds. Now it's the commercial banks are telling us this, and at the same time, but that excluded the New York traders all this time until November of this year, and now every month you're seeing deliveries like this of millions of ounces of gold and silver every single month, billions of dollars worth every single month, and again call it reverse psychology, use it contrarianism. That's a word. Why isn't anyone talking about this on the mainstream? Why do you not hear about the record deliveries? Who's taking billions upon billions upon billions? I mean, keep on going, billions upon billions every single month. Who's doing it? Who's bleeding dry the LBMA? Why is there no talk of this? It is because the lack of journalistic integrity or effort on their behalf to tell anyone what's truly happening, including the people who are trying to decide which way to invest, is ridiculous. And it's just like this pullback that we've seen, right? The mainstream media is all over it. And a lot of the things they said are valid. A lot of them are. It was overbought. It had gone up for 9 straight weeks. It had blown through moving averages. It was in need of a correction. They capitalize on all of that, and then they'll put a cap on and say maybe it's topped and it's over, just like in 2011 and 1980 before that. But what they fail to mention, which invalidates all of it, is that, the snowball that was pushed down the hill to start this going happened in the access market when New York was closed, when there were no markets open before Asia opened, when no trader, Alasdair will tell you, that trader would be fired and shot, and not in that order. Any trader that would dump billions upon billions upon billions upon billions of gold and silver at the most illiquid time of the evening, when New York is not open, no traders there to catch that, all you're doing is triggering sell stops that drive the price way down. You are guaranteeing yourself, the worst settlement. And then, of course, who did I mention? Bank of America and Morgan Stanley? Well, Michael Lynch says they came right in and scooped up physical, shows the numbers, and silver went right up. So this is all a game that is being done for maximizing the effect, the fear. And there is not one rational trader on the planet that would do that, would dump it in the access market. They would dump it over hours or days, slowly bleeding it into the system, not telling these traders how much they want to sell, slowly, so that the demand would be commensurate with the supply. But they fail to tell you that. They should have said all of these things are true, but they dumped it. They dumped it when there was no market open. So everything they say is invalidated. And all the sell stops that triggered, freaking everyone out, getting all what's going on with gold, what's going on with silver. They never called when gold was going up for 9 straight weeks in a row. And I think the powers that be understood we were entering a period of time where the public was waking up. That's a bad thing when you have a wicked short position. It was damage control. It was short covering. It was fugazi. And you'll see it right back up, I promise you, before the music stops. If this had been done the right way, slowly bled out over days and weeks in New York trading, I'd be less confident. But any idiot, stupid idiot that would dump it like that when there's no traders, well, that invalidates everything that the media said, no matter how rational and logical and valid those statements may be otherwise. That's just my 2 cents.
Well, I actually want to just pick up on an earlier point you were making, Andy. The largest mine in the world is COMEX, because this year so far it's delivered around about 1,200 tons. That's three times China's total gold mining effort, annual effort.
There you go. And who is it? And why don't we hear who it is?
Well, that's for us to guess, isn't it?
So I want to key in on this if we can, gentlemen, and that is that the guidance to ordinary moms and pops has been absolute silence and nothing to see here for the past, since about 1990 and on. So let's just say, or you could say since after 2011, say since 2012 to now, so at least 13 years, silence from the mainstream financial press about the value of gold and silver in protecting a portfolio. And yet, accumulation by central banks, Andy, you've reminded us, hand over fist for the past 5+ years. Alasdair, you've talked about that as well. But now, for the past quarter or two, when you can no longer ignore record high for both gold and silver, making new nominal highs week after week, then the guidance that's been out there is we buy gold, or maybe this is a good time, we saw it even on our local news, this is maybe a good time for moms and pops to get out and sell their gold since it's up high at all-time highs. This is the guidance that ordinary people are hearing. But I'm extremely concerned about that, but even more so how that gets magnified and amplified on the impact on ordinary people, that these good people are relying on shepherds and stewards of their funds in retirement funds, in endowments, in mutual funds, and taking care of their homeowners associations or their hospitals or their churches or schools or whatever. Those people who are shepherding funds, or their insurance companies that many are picking up pension risk transfer on behalf of employers that are no longer carrying private pension plans. So you got countless moms and pops who are relying on a concentrated management by those in the asset management industry and risk management industry who are also not until now hearing anything about the importance of protection, and they're still using the old tools. So can we focus back on the risk that ordinary moms and pops are under because of this concentrated management of assets following a regimen that has been completely ignorant of or ignoring or perhaps unable to take advantage of some of these traditionally proven methods for protecting and reducing risk?
First of all, when Bretton Woods ended, there was a big propaganda effort by the US Treasury to persuade everybody that gold was no longer part of the monetary system. Now, I think it's important to know that that actually goes against common law. Common law is that gold is final settlement and everything else is credit. And this goes back to the first set of laws produced in Rome, which were at 448 BC. That was refined by jurors in the following decades, following centuries, and then incorporated in Justinian's Pandex. And of course, out of the Roman Empire came all the countries, the European countries, from the Urals, or if you like, from Russia all the way through to Portugal, who went out and colonized the world, including the great US of A. So everyone's common laws outside China and so on and so forth, which is somewhat different, everyone's common laws had the same thing, and that is that physical metal, gold, silver, was final settlement, and everything else was credit, including fiat currencies. That's the important point. They are credit. And the value of a fiat currency depends on two things. Firstly, the quantity of its issue, and secondly, the faith that its users have in the value of that currency. And the problem is that fiat currencies always come to an end. And we've had this regime now, based on propaganda, no more, for 54 years. It's coming to an end, in my view. Why is it coming to an end? It's coming to an end because governments use fiat currencies always as a means of accumulating debt without having to, if you like, keep the value of that currency tied to gold, which limits, it cramps their style. It really does cramp a government style. So you always find that these fiat currencies end in a massive mountain of debt. That then collapses in terms of its value or counterparty or bankruptcies or whatever. And so are we close to that point? I think we're getting pretty close to it, is my view. And when it happens, everything changes. Absolutely everything changes. And I think, I'm very glad I don't actually manage money anymore, but it seems to me that this is going to be very, very difficult for investment managers to handle. And this is why I say, I've tried to sort of say earlier on, and I know people have joined since we started this, that the first thing to observe is the bursting of the credit bubble, which is being funded basically by the expansion of bank credit. That's where bank credit has been going. That's why the S&P has risen by, 50, 60, 70% or whatever in the last 2-3 years. That's the first thing. Now, when it pops, when it bursts, then you will find that everything which people own in portfolios will be sold down, particularly where they've got profits, because they will, it's human nature. When it comes to the losses, you just ride them. But what you do is you liquidate the things that have been performing well, that you got good money on. So I think even gold mines would be sold out. But the one thing they haven't got is physical metal. They don't own physical ETFs, etc. And I think that when the bubble pops, you may have to count up to 10 or something before it happens. But the next phase will be bond yields rising, making the situation worse, foreclosures in the market. You'll find foreigners will be selling what to them are foreign stocks, and bear in mind they've got 16 trillion invested in US stocks. The whole thing is going to be a mess, a huge, great mess. And trying to manage your way through that, I think is going to be very, very challenging. And my strategy, I think, would be, get gold now, because there is absolutely no doubt it won't be available at anything like these prices once these things happen. And silver, incidentally. Well, I know it's not a monetary metal, but, if you look at a gold-silver ratio of, 83, 84, this is plainly ridiculous. It should be 30 or lower. So the two monetary metals, I think you take a position in those, and then you've got to play the end of the bubble. And that basically means lightening up on rising prices from here, on tech stocks in particular. Bitcoin, incidentally, correlates beautifully with the Magnificent Seven. So if you've got that as well, I would get out of that. And when it comes to bonds, you don't want to be invested in duration. I know that insurance companies and pension funds look at matching, if you like, duration with their liabilities, of course. But as much as possible, you want to go short on duration. I think that's desperately important. And then what will happen, I think, at the end is that your position in gold will actually rescue all the other positions. And that's where you've got to get to. You don't have to have a huge amount of gold to get that. You don't need 20%. But get in there because, as I said earlier, if you look at a 1% increase in gold in global portfolios, that equates to a demand at current prices of 25,000 tons, and it is not there. It's quite simple. So, if you leave this one, you're going to miss the boat.
Thank you, Alasdair. Andy, you've been waiting patiently.
Yeah, look, I'll try to sum it up best I can. I would say you can't trust a regulator that's also the world's largest debtor. Just because the government backs their industry, the bond market, doesn't mean that bonds are safe. And I would argue the U.S. government won't default. They'll just inflate or suppress yields. But either way, you hold bonds, you lose. And the institutions, they'll bleed real value while the system all along pretends all is well, as they have and as they continue to do, as the dollar is losing massive value against gold. And I think that all of this stuff is connected, right? The risk that we find, to me, it all boils down to the currency. And the confidence in the currency, which is the glue. You lose that and the whole thing comes apart. And I think that that's really the most important part of all, is that, the rehypothecated collateral and the counterparty exposure, all these things are fragile, but the biggest risk that people are ignoring is that fiat money is losing trust. The dollar is losing trust. The bond market is losing trust. And you get a sharp bond sell-off or liquidity freeze that Alasdair talks about. It not only would it wreck balance sheets that look solid, like in pensions and insurance companies, long duration holdings, mark-to-market losses, redemption pressure, all of this would break them. And, everyone says, give me my money. It's like the laws that we had talked about, Dunagun, of breaking the buck, and the gating that they have subsequently changed to, they can just impose huge redemption fees. The point of it is that this whole thing is based upon an illusion. And yeah, as Alasdair says, absolutely shorten duration and add real assets, hold physical gold, stay liquid, forget yield chasing. It's a trap. And diversification is broken. It's a broken correlation in this world. 60-40 is dead. Diversity by risk, not by asset class. Own things that survive inflation and fiat decay. It's easy. All that's precious metals. And yes, gold and silver are essential. Physical custody, essential. It's insurance. It's not a trade. And that's what I think too many people think of. It's not a trade. You're buying it to get out of the way of what's coming. So liquidity is security. And I would take a lower yield right now with gold, or no yield, and sleep well at night. That's my 2 cents on that.
One point that both of you have made here is, and has been a refrain in comments under other interviews that we have done, is how can they keep saying year after year, look how high the debt is, look how high the deficit is, we must be near the end, we must be the end. They say, well, if we're at whatever officially stated debt and deficit numbers today, and Andy and Alasdair, you'll remind us that the off-sheet liabilities are multiples of what the officially stated debts and deficits are, that why couldn't it double again? Why couldn't it double again? Why can't this party just keep on going? One of the comments that's been, I think you both brought out on that today, is that the physical actions of off-taking of metals belies the fact that there is loss of confidence, that those who have the ability, those who are at high enough on the food chain and the sophisticated enough to have the ability to take action, have been taking action. And it's those who are still sleepwalking and still dancing to the old tune that are going to be caught unawares by continuing to rely on just staying fully invested in the system. Any comments from you on why can't this just keep on keeping on? Or are there actions that are actually belying that those who are able to are taking protective action, and they're going to be the early movers?
I think part of the answer to that is that if you look at the level of debt in the United States, I mean, the US government's debt is about 115% of GDP. The ability to pay that comes out of the private sector, the taxes, if you like, that the financial and non-financial sector provide to the government. That's the important thing. Now, if the economy goes into recession, then that impairs the ability to cover those, to cover the interest cost, and indeed to service the debt. And that basically is what we're seeing. I mean, I put out a piece this morning, and one of the charts in there was the interest on debt. And I tell you, it's scary. It's just, it sort of goes along like that, and then, it's done that. That, if you like, is really what's happening with the debt trap. And that's why this can't be muddled through anymore. This is coming to an end. It's actually as simple as that. You need to look at the whole thing in the round. The idea that we can continue to run high levels of debt. The other thing is that, we did have higher levels of debt. Most countries had debt to GDP of 160, 180, 200% at the end of the Second World War. But the difference then was that we were on the Bretton Woods gold standard. And that kept interest rates down, and it allowed for the expansion of credit, which was angled at production more than anything else. So it was inherently non-inflationary. So what you had was the ability to do yield curve control. That was the time of yield curve control. And you could also persuade investing institutions to act in a certain way. There was all this sort of, if you like, off-the-record briefing of institutions. So, but that cannot happen now. It just does not happen. You cannot have yield curve control. You cannot control the yields on the long end of the bond market. They're no longer controllable. And the fact that we're not tied to a gold standard, which is provides a severe limitation on inflation, if you like, the way prices behave, that doesn't happen either. So, this is an inherently different situation from the past, where we've had higher rates of debt to GDP and got away with it, but not under a pure fiat currency. That's the point I'm trying to make. And I think that is why we're coming to the end of a fiat currency era with everything that implies.
Andy, anything to add from you on that?
From precious metal standpoint, and I can speak to the larger economy after, but you can't keep suppressing a market when the world is pushing back against you. The only way to do so is to push it in the direction that it is going. And as I've said on your show for 5 years now, that the biggest money in the world is wise to suppressing. When you see 8 Western banks holding the largest concentrated short position on 1,000 commodities traded on the COMEX, and that being in silver for years in a row, it's not too hard to see it if you look, that it is certainly a collusion of the West for reasons. And you could argue gold for Gibson's paradox, the inverse relationship between real interest rates and the price of gold. And I would argue silver for the military-industrial complex, the need to make high-tech weapons, the need for massive amounts of silver to do so. And we've talked about that ad nauseum. I don't need to go into that, but the world is wise to us. And this is why you see coordination between countries that are sophisticated and motivated and wealthy now and understand what we're doing and using it against us by standing for delivery. In fact, probably shorting it themselves to do so. That's why China, the largest producer of gold and second largest producer of silver in the world, are actually taking the time to fly to Latin America to buy gold and silver directly from the miners, like Sean Kuhn, Dolly Varden, who told me this, and paying double what the West will, and sending it back for refining when they're already producing more than anyone in the world. Why would they do that if it means nothing? They see the big picture. That will end. And in terms of the way that this sequence goes on the bigger picture, we're seeing inflation spiking, I think. I mean, they're giving up to it. It's at 3%. It's much higher, which we said it's 11, really, if you ask John Williams. And they're going to pour more gasoline on the fire right now, even though they're 50% away from their target. To Alasdair's point, this would lead to bond losses. To Alasdair's point, again, this would lead to central banks panicking, doing yield curve control, suppressing interest rates, which leads to currency declines. And if the currency is declining already in a period of time where no one trusts the institutions and the markets really anymore, because we have weaponized the treasury against countries like Iran and Russia, yet we've been in Iraq for 22 years under false pretenses, destroyed their country, toppled their regime, and we're still there occupying their country. How is that fair? Now, I'm not making any judgment on Iraq or on the Ukraine or Russia war, but how is it that we can tell Russia, well, you know what, we're going to take your treasuries that you have stored with us and we're going to confiscate, in essence, default on them, and we're going to give it to, largely in the form of weapons, to the Ukraine. And that's okay, but we go into Iraq for faulty reasons, and we're still there 22 years later, and we've just decimated the country. So when you talk about trust, there is none any longer. We are not trusted. That's why U.S. Treasury holdings are down to their lowest level ever, like 39% across the board. And so as it goes from inflation to bond losses to the panic of yield curve control or suppression of interest rates to your currency declining, along with no trust, you get a flight to hard assets. And isn't that what we're seeing right now with the acquiescence of the big commercial banks to tell their institutional clients, you better get 20% of your assets in gold now? And I think people and institutions need to front run that sequence, period. And it's really not hard to see that. I think for me, my assumption that I make is that you build a policy assuming inflation and currency risk is real. And we've lived, this is a problem, all of us in the West have lived in a world where bonds were risk-free. They're not. And that currency was permanent. It's not, right? My father, first year out of college, married my mother, and $6,000 a year starting salary at Helene Curtis Cosmetic Company way back when was enough for him and my mom to live comfortably on $500 a month, comfortably, in 1963. And I said, there's no way, Dad. Yeah, look it up. The average salary was 10 grand that year, 9 or 10 grand. So out of college, first job, okay. All of this stuff is not permanent. And this was during a time when the United States and London, UK, were revered, were thought of as the bastions of honesty and integrity and free market enterprise, and they're not. And now we have policy that is coming in that is frightening the world through sanctions and tariffs masquerading as tariffs that are actually sanctions, and fiscal irresponsibility to the nth degree, where we create $1 trillion of debt in 71 days, right? Trillion sections ago was 31,688 years ago. We can create $1 trillion of debt in 71 days. And we bring on a company or a group like Doge, who finds $2 trillion in things that could be cut, but Congress can't agree to more than $200 billion. That's about 38 hours of spending by the U.S. government. So if you assume that inflation and currency debasement, what are they calling it right now? The debasement trade. Oh, really? They're just getting on that? So if you assume that currency and inflation risk are real, and that bonds are not risk-free, and that the dollars you hold are not permanent, in fact, they act more like a melting ice cube, then you'll be better off and understand the reasons to hold gold and silver, not to become wealthy. You might if you own enough, but because it is wealth, that the smartest money in the world is telling you through their actions they agree. The most well-informed money in the world is telling you they agree. Take it for what it is. Don't take my advice. Look at what the big money is doing, and you'll see that they're leaving the equity markets and they're moving to tangible commodities in their own possession. And that is the truth.
Alasdair, any comments from you? Because you both have a heart for ordinary people. You really would like to look after the best interests of common people, about the exposure that common people have when their financial futures are being managed by those who aren't aware of what Andy just outlined and what you've just outlined. Is there anything you think individuals can and should be doing, and those who are watching out for individuals need to start doing? It sounds like there's not going to be enough to go around, but what I'm hearing is early entrants are going to have a better chance.
Well, various economists have said that not one man in a million understands money, or including, I would say, those economists. That's probably being a bit harsh. But I mean, the fact is that you need to understand the difference between common law money, which is final settlement, and that is precious metals, gold or silver or whatever is accepted in your jurisdiction, and credit. All the rest is credit. And this was said by John Pierpont Morgan in evidence to Congress, I think, in 1912. Gold is money and all else is credit. And he's absolutely right. It's still true, despite all the propaganda that governments throw at us. If you understand that, then you have got, if you like, the basis of beginning to understand what is happening to the value of credit and how it is likely to proceed from here. And I dedicate myself and through my Substack to educating people about this and to, if you like, trash, rubbish, if you like, macroeconomics. Macroeconomics is not a science at all. It was invented by Keynes on the back of his general theory. You've got to actually understand money and old-fashioned classical economics. And if you do that, then you have got a very good chance of protecting yourself from some very violent financial times ahead. So my mission basically is to try and educate people so that they can survive it. It's a time when you protect your wealth, stop trying to accumulate it. Those days are gone.
We're grateful for both your presence here. Thank you for this extended episode together to explore these topics. I will put in the description of this video links to articles in the mainstream financial press that do address Andy's points that you raised about Morgan Stanley favoring the 60-20-20 portfolio, about Barnett saying that stay long gold as a hedge against the US dollar, a Morningstar article about the largest asset manager, the bond king, agree go to silver and gold. So those will be in the description of this video. If anyone wants to reach out directly, we have a hotline at 888-81-LIBERTY. That's 888-81-LIBERTY you can call. My name is Dunagun Kaiser. As the host of Liberty and Finance, I'd be happy to do follow-up questions with you as needed, and we'll be posting this so that we'll send a link out so that anyone can, you want to share this with, who wasn't able to make it for the recording, can join in. Either Alasdair, and Alasdair, you have a Substack. Where can people find that?
Yep, it's MacLeodFinance.com, MacLeod finance.com.
Andy, you've got a podcast where you discuss these topics on a recurring basis. Where can people watch you?
Yeah, and we're very happy to have welcomed earlier this year Michelle McCory to the staff. That's Miles Franklin Media on YouTube. She has one today. Who is she interviewing today? Michelle is interviewing James Lavish today, and she's fantastic. So yeah, Miles Franklin Media on YouTube.
We're grateful for everyone being here. Thank you all for joining us.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for October 27th through November 3rd, 2025, while supplies last. First this week, 1-ounce gold Valcambi combi bars that can be broken into 10 1/10-ounce bars are just $215 over spot. Next, 90% constitutional silver is just 30 cents over spot per ounce. Finally, assorted silver rounds are just $2.99 over spot per ounce. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.